Hello and welcome to Value Research Podcast. You're listening to First Page, a column written by Dhirendra Kumar. The paradox of price. Why investors chase expensive stocks and shun bargains. A peculiar psychology at work in the investment world defies most rational thinking. We're naturally drawn to bargains in virtually every other aspect of our lives. We're thrilled to find quality goods at reduced prices, queue for sales, and take pride in discovering value even if it's just a fake discount label. Yet, when it comes to investing, this fundamental instinct mysteriously reverses itself. Suddenly, expensive becomes desirable and cheap becomes suspicious. This contradiction isn't theoretical. It significantly impacts wealth creation and destruction. Investors who succeed in building substantial wealth over decades often do so by embracing what feels counterintuitive. Buying when others are selling, investing when sentiment is poor, and seeking opportunities in the market's unloved corners. They understand that price is only half the story. The other half is what you're getting for it. Look at market cycles. During euphoric phases, investors pay premium prices for stocks with spectacular past returns, believing momentum will continue. Meanwhile, similar or better companies trading at a discount get ignored simply because they lack the glamour of recent performance or the validation of popular approval. This behavior creates one of the market's enduring anomalies, the outperformance of seemingly unattractive stocks. It's a phenomenon that has persisted across decades, regions, and market conditions, yet remains underappreciated by most investors. This pattern reveals a core truth about market efficiency: its absence. Markets process information efficiently, but emotions inefficiently. Fear, greed, hope, despair, these create persistent mispricings that patient investors can exploit. The real challenge isn't spotting these opportunities, but acting on them when everything in the market suggests otherwise. What makes this particularly relevant now is the current market backdrop. After years of growth stock dominance and momentum-driven investing, we're witnessing a gradual shift in investor preferences. The easy money of the past decade has created a generation of investors accustomed to paying premium prices for premium growth, but markets have a way of humbling such assumptions. Yet, there's a deeper lesson here about the nature of value itself. Price is what you pay, value is what you get. This simple distinction, popularized by Warren Buffett, captures the essence of successful investing. A stock trading at a low multiple of earnings isn't automatically a bargain. It could be cheap for good reasons. Similarly, a stock trading at a high multiple isn't automatically expensive. It might be worth every penny and more. The skill lies in distinguishing between the two. The distinction is crucial in today's noise-heavy world. Investors are flooded with data and opinions and often mistake information for insight. The most valuable skill is not precise valuation, but the wisdom to spot when the market's assessment of value diverges significantly from reality. The cover story of Wealth Insight August issue explores this balance by observing a particular metric and one specific investment philosophy. But the principle applies broadly across growth and value, large and small caps, domestic and global opportunities. The central question remains: are you paying a reasonable price for what you're getting? The answer to that question and the discipline to act on it often separates successful investors from the rest. In a world where financial markets increasingly resemble entertainment rather than investing, perhaps the most radical act is to remain focused on the basics: buying good businesses at reasonable prices and holding them for the long term. It's not glamorous, but it works. Want to learn how to find value where others don't? At Value Research Stock Advisor, we help you identify quality businesses trading at reasonable prices, based on time-tested investing principles, not hype.